Okay, folks. Did you get a chance to pick up your quizzes? I'll leave them out till Friday night and bring them in. And then I still have probably 100 quiz ones. I don't know what you think is going to happen to them, but they just sit there until I think 2 weeks after the semester is done, I throw them all into recycling. Otherwise, I'll be drowned in quizzes. So I don't care if you pick them up or not, but I'd suggest you pick them up because I'm not the Pope. I'm not infallible. I screw up on my grading. And it's in your best interest to check to see that, especially those quizzes I graded around 11:45 at night. God only knows what I was, what I was even on at that point in time. Whether I was even awake, half asleep. So if I messed up, here's all you need to do. Don't make up elaborate emails on what you did. Take a picture of the page where you think I've screwed up. Tell me where you think I've screwed up. And I will add the points on if it looks like you have something, that I really missed something. Or if not, I'll tell you no, that's not going to fly. So that's all you need to do. So nothing needed, you don't have to come in and make a case. There's no case to make. You either missed something or I did not miss something. So today we're going to talk about pricing. Very different. It's almost a mindset shift. And you're going to start to see the shift happen during the course of the day. So let's start off with something that I'm going to back up today. Much of what you see out there, whether you worked as an intern, whether you go to work for a bank, much of what you see described as valuation is really pricing. People like to do pricing for whatever reason. And one of the reasons that many analysts give for why they like to use PE ratios and comparables and not use a discounted cash flow model is they say, look, you make a lot of assumptions when you do a discounted cash flow valuation. Do you? Think about that DCF you turn in, right? All assumptions about growth and margins and reinvestment. And part of you was screaming, I have no idea, but you had to do it anyway. Think of how much easier it is to attach a number to a company by saying, hey, the PE ratio for other companies in the sector is 20. I'm going to multiply the earnings per share by 20, and there's my price. In other words, it doesn't look like you're making assumptions about cash flows, growth, and risk. Is that true, though? That when you use a PE ratio, you're not? Why not?
Well, like a PE ratio has like a growth rate, and I have savings, and you're making other assumptions about the company as well.
About risk. In fact, you're making assumptions about cash flows, growth, and risk. You are making exactly the same assumptions you did in your DCF, but you're making them implicit. You're saying, so what? Let's say you're making an implicit assumption of 80% growth in your revenues over time. Wouldn't you want to test that assumption? At least with an intrinsic valuation, when you make up a really crazy number, you've made it up, you worry about it. With pricing, you don't even think about it. So one of the things I'm going to talk about today is to take a multiple and back out from it the assumptions about cash flows, growth, and risk, where I'm almost reverse engineering so we can ask, what are those implicit assumptions? Let's make them explicit. Second, how many of you liked your statistics class? You had to take statistics, right? When was that? First year, second year? First year. What's the objective of statistics? Why do we take statistics? I know it's because required. You say, what do you mean? Why is it? I would never have taken if it wasn't a required class. But if you get past the required part, what is the end game in statistics? What is it going to help us do? In other words, it allows us to make sense of large and contradictory data. Both pieces need to be in place, right? If you have only 5 observations, you don't need statistics. You can eyeball the data. If all of the data points in the same direction, you don't need statistics because it's all pointing in the same direction. It's because you have large and contradictory data. Statistics helps you make inferences. Do you have large and contradictory data in markets? This is the mother lode of large and contradictory data. If I taught a statistics class, and thank God I don't, but if I did, I would build it entirely around price earnings ratios and companies across and making it about statistics, because this is big data before big data became a buzzword, right? This financial markets is where you have large and contradictory data. But in statistics, unfortunately, you leave the class, selective amnesia kicks in, and everything you learned during the class somehow gets wiped out. Especially when you talk about distribution, the only distribution you end up remembering is the normal distribution because you say, you know, I'm normal, I'll pick the normal distribution, but whatever the reasoning is. And what's the nice thing about the normal distribution? Why do we so love the normal distribution? What is it about the normal distribution that makes it so easy to work with? It can be described with 2 parameters. What are the 2 parameters? The mean and the standard deviation. When I go to complicated distributions, I need 4 parameters, 5 parameters. So it's nice to work with normal distributions. Can a PE ratio, let's say you compute the PE ratio for every company in the market. You put up a distribution. The way you do this is to do what's called a histogram. Remember those from statistics? You count the number of companies, PE ratio 0 to 4, 4 to 8, and you put it in a. Can PE ratios be normally distributed? Go back to your normal distribution. What's the low and the high value in a normal distribution? Goes from minus infinity to plus infinity, right? What's the lowest value PE ratio can take? 0. Why? Because when earnings turn negative, the PE ratio becomes not meaningful or not available. So the lowest value you can get is 0. What's the highest value a PE ratio can take? You don't see infinity, but it can be really high. You know what the highest PE ratio among US stocks was at the start of 2023? 86,400. I think that must be one highly priced stock, right? It's trading at about $8 per share, but the earnings per share dropped to a fraction of a cent. It was just on the verge of going negative. The PE ratio become explosive. Now you may say, who cares? That's inside statistics. No, about you, but I remember what my statistics professor told us when he talked about this. It's called an asymmetric distribution. It's got a right tail, but no left tail, right? 0 potential. He said, don't trust the average. Why not? What's wrong with the average when you have an asymmetric distribution? What's going to happen to it? It's going to get skewed which direction? Too high or too low? Too high, because all your outliers are big positive numbers. There's nothing to offset on the other side. Now, do you see why we should care about statistics? How many times do you hear an analyst get on CNBC and say, this stock is cheap, complete the story, because it's trading at a PE ratio less than the average for the sector. If that anchor had a brain, that might be asking for too much. You know what you should have asked the analyst right away, right? What's the median? You know what most analysts say? What's the median? This tells you something about the state of statistics we're in. But if you're using pricing, you almost should never use the average, right? The average is going to be too high. Today, I'm going to show you the average PE ratio for US stocks and the median, and you're going to be shocked at how big the difference is. One final point, and this is going to start the process of questioning. To me, one of the things that makes for good pricing is when I try to sell you something based on a multiple, you know what questions to ask. I think you already have the ammunition. Let's see if you can put it to use. So I'm trying to sell you a stock, and I'm selling it on a very simple story. The PE ratio for the stock, the software company, is 12. And the median PE, let's replace the average with the median. The median PE for the sector is 20. It's trading at well below the median. And I'm saying it's cheap. Play devil's advocate. Ask me the questions. You know what, why you're asking questions. You want to see whether it's in fact cheap or whether it deserves to be cheap because there's something holding it back. So what's the first question you're going to ask me? Yes. Or in this case, what's the growth rate going to be? Margins are good. So what's the growth rate, right? And let's say out of every 100 companies which have low P ratios, here's what it says: 60 have growth rates well below the industry average. So that's your first reason. Maybe it has low growth. Second question. Think back to intrinsic valuation. Think all the things you worried about. How risky is it? And there's probably a lawsuit hanging over its head. There's some issues with the company. It's a high risk company. So it could be low growth, it could be high risk. Let's complete the cycle. Is all growth created equal? We talked about value creating growth and value destroying growth. And in the context of equity, what's the metric we look at to make that judgment on whether growth is good or bad? It's an accounting ratio. Return on equity, because it's equity. And I'm looking at what's your return on equity. And if you have really low return on equity, that might explain the low PE ratio. It could be low growth, it could be high risk, it could be low return on equity. Here's a statement I'll make up front. For every 100 stocks that look cheap, 95 deserve to be cheap. Because there's something holding them back. With pricing, what you're trying to do is find the 5 stocks that have a mismatch. So let's complete here that mismatch here. What do you want to find in your perfectly mispriced stock? You want to have a low PE ratio, right? You want to have low growth or high growth? You want high growth because you want to, so you're on a roll here. So you start with low PE, you want high growth. You want low risk or high risk? Low risk. So you want low growth, low PE, high growth, low risk. You want a low return on equity or a high return on equity? You want a high, you think, what chance do I have finding something like this? No harm looking, right? I don't know how many of you have access Capital IQ. Capital IQ, you can screen any market you want. So here's your first screen. You say, find me every stock with a PE ratio less than 15. You get thousands. Second screen, find me companies with growth rates greater than 10%. You can pick 20 if you want, but that might be getting greedy. That 1,500 stocks will now become 300 stocks. And they say, find me stocks with a beta less than 0.75 or whatever proxy for risk you want. Remember, you're no longer in the intrinsic value world. If you want to go to standard deviation or some other measure of risk, the 300 will become 65. So find me companies with return equity higher than 20%. You'll have 11. You think only 11? Yeah, how many stocks you plan to buy right away? 11 sounds pretty good to me out of the, think of how, that's the screening process. So one of the things I want to go through is with PE, I said it's growth in earnings, it's risk in equity, usually, and it's return equity. I want to come up with the same kind of mechanism with other multiples, EV to sales and EV to EBITDA, because if you can do that, you can do pricing well. So let's go back to packet 1. We have a few pages to wrap up this. If you didn't bring packet 1, fine, but no, I want to at least mop up those last few pages. But I'm going to introduce the notion of pricing. So we're, 18 sessions into this class. Every session we've spent on intrinsic valuation. What drives intrinsic value? By now, you know, it's cash flows, growth, and risk. A discounted cash flow model might be the process by which we bring those to play. But in intrinsic valuation, you're trying to estimate the value of a business based on its fundamentals. In pricing, the pricing process, at least, is driven by demand and supply, right? You're saying, but aren't demand and supply driven by cash flows, growth, and risk? Yes, but they're also driven by mood and momentum. In the case of GameStop, revenge. I mean, who knows what drives it? It's human emotions. That's a whole idea of behavioral finance trying to explain the pricing process. So let's do a first stop. The value process delivers value. The pricing process delivers price. Could the two be different? There's a gap. Let's call it the gap. I think one of the great things about being the store, the gap, is every time you'd go to London, I think the underground there was designed to promote watch the gap. And I keep thinking, this is great for the store. Maybe this is why they picked the name. There's a gap. Everything in investing is driven by what you see driving that gap. Let's start with one extreme. If you believe markets are efficient, what's your view on the gap between value and price?
Your reaction is what gap? If there's a gap, it's random, it opens up, it shuts down again. So if you're a believer in efficient markets, it's not that you don't believe in, but basically assume that the value process and the pricing process deliver roughly the same number. Let's say you're a value extremist. You're saying, who's a value extremist? They show up in Omaha once every year for that meeting of other value extremists. They believe the whole world revolves around their idea of value, that the rest of the world is shallow, barbarians, setting prices. So in their view, they hold the high ground, right? Their value. So what's going to happen over time? They're convinced the price will converge on value. So their view is, who cares about those shallow people? Well, we have the high ground here. Right? And then you have pricing extremists.
My favorite show to be on CNBC. I never watch CNBC. The only time I ever am on watch CNBC is when I'm on and I have to watch myself on the screen. Is Fast Money. The Fast Money is after the market closes, there are these four people who get on, and you've probably all seen them. They're all traders, not traders, but traders. And I love being on that show because there's no hiding behind we care about value. They're open about the fact that they don't care about value at all. Who cares about intrinsic value stuff? They say, we're traders. You know how you make money as a trader? You buy at a low price, you sell at a high price. Why? You don't care. You do it by looking at astrological charts, all the more power to you. It doesn't have to be something rational. You just have to make money. And I like that honesty. But what are they saying? This notion of intrinsic value is in your head. You have too much time on your hands. You play intellectual games. You come up with the value. Nobody cares. People go out and buy and sell stuff. Think of that as a trading exercise. I want to focus on the value side. Let's say even if you're not an extremist, at this point, you like this value stuff. You think there is basis for making money and value. Let's think about the challenges you face as somebody who believes in value and wants to make money. I think you face two dilemmas. The first is you valued a company, you know all the mechanics, you come up with the value. Are you uncertain about the value you sent me? I would hope so. Otherwise, you have something wrong internally, right? Because I mean, you're trying to play God. You're saying this is revenue growth, these are margins, this is the sales to capital. And to different degrees of uncertainty, depending on the company you're valuing, you're feeling pretty uncertain about the value. So first, let's be quite clear. You value a company, you have an estimate of value. You don't know the value. But even if you feel comfortable with your value, what's the second piece of the puzzle? The price has to adjust to value, right? Is that certain to happen? The value extremists think it is. But there's nothing in this process that requires price go to value. So you're uncertain about the price converging on value. Do you see where I'm going? Even if you do everything right, you're uncertain about your value, or uncertain about price adjusting to value, which means if on any one company, there is a great chance that you could be right and still not make much money. It's one of the arguments I make against those people who believe in concentrated portfolios. You know what those are, right? There are some value investors who believe you should buy only 5 really good companies. That diversification is a sign of weakness because you're spreading your bets. In my response, if you buy only 5 companies, you must feel really certain about the value you come up with. And they say yes, and you must feel really certain about price adjusting to the value. If you do, if you feel that degree of certainty, by all means, concentrate. I'll tell you what I feel. I feel incredible amounts of uncertainty when I value companies. I feel incredible amounts of uncertainty about whether the price will adjust to value, and you know how it plays out. I have to spread my bets. If you view that as a sign of weakness, that's fine, but I need to do that because of the uncertainty. And the greater the uncertainty, the more you need to spread your bets. Do we live in a world with more uncertainty than 40 years ago? Absolutely. Globalization has done it. Disruption has done it. If nothing else, maybe 5 stock worked in the 1980s. It's not going to work anymore. But let's focus on this closing between the price and the value and think about what you as an investor can do about it. So you valued a company. Let's say it's the value you get is higher than the price. Let's say you actually put some money behind this. You go buy the stock. One approach you can take is what I call the karmic approach. What's a karmic approach? I don't control this from this point on. I've done my work. I'm going to go back to living my life. It's very healthy.
choice actually, but very difficult for most of us to do because partly because we get too much feedback, right? In the 1960s or 70s, you know what made the karmic approach work? Is you bought something, you didn't even know what was happening to it most of the time. Until you got that broker statement once every 3 months. Today you get, constant feedback. Your karmic approach is not working. 2 minutes ago, it wasn't working. So in a sense, you tend to react. The second is, it's nice if you can get a catalyst. We talked a little bit about this at the start of the class. It's nice if right after you buy a stock, it has to be right after, thinking it's undervalued, Carl Icahn also bought the stock. Why? Because he's going to be the catalyst that causes the change that moves price up to value. But unless you have a direct pipeline to Carl, this might or might not happen. So let me suggest a couple of other catalysts. One could be a management change. Management change comes in, something that redirects attention to the company. But it could be something that on the face of it looks very, you look at it and say, who cares? I remember when Amazon and Apple both crossed $1 trillion market cap around the same time. Now, by itself, there's nothing special about $1 trillion. From an intrinsic value standpoint, 999 million, billion, 1 trillion, who cares, right? But there is this special, we put numbers around, the Dow crossed 30,000. So for whatever reason, usually 3 zeros at the end, we think, oh, this is a special number. But I'll tell you why, even if you're a value investor, those things might matter. Amazon and Apple crossed $1 trillion. I got at least 15 calls that day from different financial, because they wanted to take a look at what is special about the company. You see what this means, right? You get scrutiny on your company because of this arbitrary line. And what are you hoping? In the process of that scrutiny, maybe people will reassess the company. And I know it's asking for a lot, but you're looking for something that draws attention to the company because you feel that that attention will translate as a catalyst. So let me give you a very simple example of how this plays out in real life. I admitted at the start of this class that is far too biased to value Apple, but I've done it anyway. Since 2010, I value it. My valuations are public on my blog, and I usually at the end of the valuation say I'm holding if I already own Apple, I'm selling if I think it's overvalued, or I'm buying. This is actually valuations I did between 2010 and 2019. If you go to my website, you'll see it all the way through 2022. So every year, at least once a year, I visit Apple, I value the company and compare to the price. So if you take a look at my value and price, when I first started in 2011, it was, my value was 69. I found it undervalued by 21%. Now, 1 year later, it's overvalued. So you can see as you look across those numbers that it goes back and forth, right? And with Apple, you can see why. The core story for Apple stays the same, but people get irrationally exuberant when they sell a lot of iPhone 13s and they push up the price too much. And they get too depressed when it has one bad quarter. So this is the end. I wish Steve Jobs were back, and they sell off all the stock. And you might view that that's so crazy and irrational, but this is your opportunity, right? If you believe that your value is built on a good story, and your story, and the longer you get familiar with the company, the more you're going to get more comfortable with your story, because you're going to get input data that you use for your story. Don't give up on your stock is what I'm saying. I would say right now I'm looking at about 70% overvaluations and 30% undervaluations based on your numbers to me. So more of you are finding overvalued companies than undervalued companies. I'm going to show you what that statistic has looked like over the last 30 years. I've tracked that percentage of class, so you can see whether it's a good leading indicator or a lag indicator. But many of you are finding your companies to be overvalued. And part of you is saying, I wasted 10 weeks of my rate. I get a grade, but this is such a, I'm not going to be able to buy the stock. Don't give up on it, because it could be overvalued today, but a year from now it could be undervalued. So this is a process. You open the door. If you really like the company, do this only if you picked AT&T because you thought it was going to be easy and it bored you to help to value the company, just let it go. But if you picked a company that you found interesting and you find it overvalued today, keep track of it, because it could be undervalued a year from now or 2 years from now, because that is the process of price and value. The value will move over time, but price will always move more. It'll overshoot and undershoot.
and you're trying to take advantage. So I'm going to close the intrinsic value section with a picture from one of my favorite movies. You know what this movie is, right? Somebody said no. Come on, this is one of the most, it's a Wizard of Oz, right? It's been 1938. It's one of the first colorized movies. It's now been digitally recolored. But I'll tell you the story of the Wizard of Oz, and don't jump down my throat because you think the story doesn't make sense. It's not my story. It's a Wizard of Oz story. So here's what happens in the story. This girl called Dorothy is living in Kansas. I don't know where in Kansas, they don't specify. Somewhere in the farmland somewhere. A tornado picks her up off the ground and drops her into this mythical land called Oz. I told you, don't pick on me. I don't make up these stories. She lands on a witch. I'm always confused about which witch from the east, which from the west, but she kills the witch. So she's facing homicide charges. And she wants to get back to Kansas. This is how the movie begins. It all happens in the first 7 minutes of the movie. So if you have a kid, take them in 10 minutes late. It's traumatic, right? So she wants to go back to Kansas and she has no idea where she is. So she turns to this munchkin by the side of the road. I don't know what else to describe, but they're small people. And she says, I want to get back to Kansas. How do I do it? They said, we have no idea. We don't even know what Kansas is, but go ask the Wizard of Oz. She says, how do I get to the Wizard of Oz? She says, follow the yellow brick road. And for 3.5 hours, the movie's really long, that's all she does. She hops and she skips. She never walks. If you watch the movie, she hops and she skips down the yellow brick road. And along the way, she collects this motley crew. A cowardly lion, a scarecrow, each of them wants something. And they each all go see the Wizard of Oz. So this group gets together. They walk all the way down the yellow brick road. 3.5 hours later, they show up in the wizard's chamber. The wizard, for some reason, is sitting behind the curtain. That should have already raised suspicion, but they weren't. They were a very naive group. So each of them says, I want this. And the wizard says, I'm busy today, come back tomorrow. It's like a government office. They said, we can't come back tomorrow, but we've been spending 3.5 hours on this brick road coming to you. And at this stage, the curtain falls, a wardrobe malfunction from those days, I guess. And they see there's no wizard behind the curtain. There's this guy pulling strings and rods, and they realize there's no Wizard of Oz. It's a terrible story, right? 3.5 hours later. But it turns out that each of them got what they wanted on the journey. Remember what Dorothy got? Red shoes, right? She clicks the shoes, she's back in Kansas. The cowardly lion fought off bad guys, got courage along the way. You say, what's this got to do with valuation? Maybe nothing, but it's a good story anyway, right? But here's what I think it has to do with valuation. Valuation is full of people thinking there's a Wizard of Oz out there. That if they have a question in valuation, if they can find the wizard and ask the question, everything will be okay. The wizard might have a name like Google search, right? What tax rate should I use? You type in Google search, what tax rate should I use when I compute after-tax cash flows? With ChatGPT, you can say, what would Aswad Damodran ask you to use as the tax rate? And you get an answer, right? So life's so easy. And I think along the way, we've lost something of immense value, which is we don't try to reason our way to an answer. You know already everything you need to be able to answer that question. If you said, what am I trying to estimate here? I'm trying to compute the after-tax cash flows based on earnings. And then you could say, well, what tax rate makes the most sense? You don't need a Wizard of Oz to answer that question. I actually wrote a piece for a teaching magazine called the Google Search Curse. Because incredibly, that's what we do, right? When we have a question, we think, this is so easy. Let me type Google search. And it's true, it saves us time, but we're losing that capacity to reason our way to answers. And the more we don't use it, the less powerful it becomes. It's like any other muscle. So here's my advice to you. The next time you get stuck on a valuation question, I'm talking about during the class, you can email me. This is the class you paid, I don't know, 8,000, 10,000 for this class, some obscenely high amount. You're entitled to ask questions and you should get answers from me. But this too shall end, right? On May 8th, and then you're going to go off and it's going to be a year later, you're at work and you say, what should I do here?
You're going to be tempted to send an email, and you're welcome to do it. I don't even know where I'm getting my emails from. Most of the time I answer them because it's a safe thing to do. But I want you to spend at least 20 minutes thinking about, hey, how would I reason my way to an answer? No, it's tough to do because it's become too easy to find answers there. Work on it, because that muscle will get stronger, and over time you'll discover you don't need a Wizard of Oz to answer your questions. You learn the answers during the process. You know, the most useful part of evaluation is not what that bottom number is. It's what you had to go through to think about revenue growth and think about margins and think about, painful though it might be, that is how you learn valuation, is by thinking through how do you answer those questions, even if you get them wrong. So with that long lead in, let's turn to the second packet. If you didn't bring the second packet, not a big deal, but no, but at some point you need to get it. Let's talk about pricing. I'm sorry, did I lose them? There you go. You guys on Zoom, can you see the second packet? There are 15 people there. Maybe they've all gone to a restaurant and slept themselves on. So let's talk about pricing. First, let's set the take. What is pricing? Pricing, as I said, is a mindset shift. Instead of asking, what is the value of this business based on what it does, what its fundamentals are in pricing, the question you ask is, given what other people are paying for similar things, how much would I pay for this thing? Right? That's what pricing is. So if you think of breaking down pricing, there's three parts to pricing. First is, to price something, you need to find other things just like it. In real estate, how does this work out? To price a house, you're trying to find other houses in the neighborhood. I was supposed to go to opening day at Yankee Stadium with my son who works at a hedge fund, but one of the downsides of working at a hedge fund is they pay you a ton, but then they demand strange things of you, like you have to work between 1 and 4:30 in the afternoon. It was like Friday afternoon. So he called me at the last moment and said, I can't go, Dad. So, okay, we'll go on Sunday. Sunday was a day game and he sleeps in late. So 2:30, I get a text from him saying, did you get tickets to the game? I said, the game is already halfway done. You just woke up. I'm not getting tickets to the game. It's too late. So he said, we should go to a game. I said, I agree. So I'm getting tickets to a game like 10 days from now. And I went to SeatGeek to get tickets. You use SeatGeek? SeatGeek is an aggregator of all these different sites. The nice thing about SeatGeek is you get StubHub, you get tickets, they're all there at one place. And SeatGeek not only gives you deals, it actually ranks deals from awesome. I don't know what the worst deal is, but horrific. This is a great service they're providing, right? But you know how they rank the deals? They look at other tickets in that section because, I think the section I got was like 130 or section 130. They take all the seats. And the computer is sophisticated enough to know that row 3 is better than row 10, and aisle seat is better than a middle seat. So you've taught it all these rules. So it basically prices the seat. You can see how it's more difficult with the stock, right? Because you don't no longer have sections and you can have very different pricings for individual companies, but that's the first step, finding comparable assets which have been priced so you can use that pricing. Second, if the pricing is all over the place, as is the case with equity, Berkshire Hathaway is what, $500,000 per share, you got penny stocks, you can't use prices to compare, you got to divide the price by something. You do that, you get a multiple, standardizing the price so you can compare across these companies. So you get comparables, you standardize the price, and if you're careful, you ask the questions like you did with PE ratio. What's the growth rate? What's the risk? What's the return equity? You control for differences. All pricing, that's essentially the process. So I'm going to start with a statement and I'll back it up. And a statement I started this class with. Much of what passes out there as valuation is pricing. So let me back up that statement. About 20 years ago, I collected 550 equity research reports from around the world. I'll confess, I didn't read most of them. I collected them because I wanted to chronicle how equity research analysts came up with
buy and sell recommendation. What do they base it on? Out of the 550 equity research reports, 45 were based on intrinsic valuations. 45 out of 550. The rest, you know how the analysts would come up with a buy or sell? Based on a multiple and comparables. PE ratio, this company looks cheap because based on these 15 other companies. Am I surprised? Not in the least. Equity research is a pricing job. You know why? Because I put you in a sector. What do I ask you to do? Tell me the 3 companies I should buy, tell me the 2 companies I should sell, given this sector. So much of what passes for valuation in equity research is pricing. I said, maybe it's different in corporate finance. You're acquiring companies, presumably use intrinsic valuation. So I got my hands on 100 acquisition valuations. And this is really difficult to do because you know what bankers do right after they complete an acquisition? They take those valuations, they put them under lock and key. They try to destroy them, complete evidence of them because they're worried that you might actually check their forecast against the actual numbers and they don't want that to happen. But I have my sources and I was able to get to 100 acquisition valuations. And at first sight, they looked like they were more discounted, about half claimed to be discounted cash flow valuations. But then I took a closer look and I realized, and I might have used this term before, but I'll use it again, that they were really pricing in drag. What's the drag part? Remember, the biggest number in a discounted cash flow valuation is the terminal value. The terminal value came from using 8 times EBITDA. This isn't a discount. So even in acquisitions, it seemed to be pricing all the time. Does that surprise me? Not in the least. Because how does a banker make money on an acquisition when a deal gets done? So like the realtor, he's going to go with the pricing or she's going to go with the pricing. So much of what you see out there, most of your jobs will end up being pricing jobs. It's a given. And many of you will use pricing. And when I first encountered these numbers, I was a little surprised. And I'll tell you why I was a little surprised. When you leave this class, I'm going to do an exit interview. Don't worry, I'm not going to ask you about your personal feelings and where you are. The exit interview is now that you've taken your company and you've done an intrinsic valuation and a pricing of your company. That's what's left to do on your project. And thankfully, it's much less work than a discounted cash flow valuation. Now that you've done both, if you had to hang your hat on one of these approaches, which one would you pick? And in the class, in the 30 years that I've been teaching the class, the numbers are pretty consistent. Let's see if this semester it varies. It's about 70, 20, 10. 70% pick intrinsic valuation, perhaps reflecting my biases. 20% say this pricing part was so much better. It's, you know, I didn't have to do this revenue growth margin crap that you made me do with intrinsic valuation. And 10% become believers in efficient markets. After let's face it, after you value a company, you realize this wasn't that easy. Maybe I should cut the market some slack. Maybe crowd wisdom is really crowd wisdom. That's actually a healthy recognition, if you ask me. Because think of how much money you've saved over your lifetime now and how much time you've saved because of the recognition that this isn't for you. But 7 to 2, when they leave my class, they're saying they're believers in intrinsic valuation. I haven't done this, but I should do it one of these days. I should track these people down 5 years after they graduate. Maybe I'll make this the class where I do it on. So around the year 2028, expect some kind of missive from me. I was going to say an email, but who knows whether emails are still around. But I'm going to ask you the question. I remember 5 years ago when you left my class, I asked you this question. What exactly are you using in your job right now? Are you pricing things? Are you valuing them? I'll wager that the numbers get switched. I started thinking, what is it that happens between the time you leave my classroom and you start working at that trading desk or whatever desk you're at that makes you go from being true believers in intrinsic valuation to users of pricing? And the first of the answers came to me while I was watching a Seinfeld episode. Everybody's watched Seinfeld, right? I mean, if you live in New York, you have to. It's almost a requirement. And at least we get soup from the soup guy. You know, it's a Seinfeld episode right there. But there's actually a Seinfeld episode where one of Jerry's girlfriends accuses him of being crazy. Says, Jerry, you're crazy. And he says, if you think I'm crazy, you should see the guy who lives across the hall from me. You know who lives across the hall from Jerry? A guy called Kramer. And I ask you a question. Relative to Kramer, is there anybody crazy?
This is the advantage of pricing. We forget how much a valuation is selling. It's so much easier to sell a pricing than a valuation. I'm trying to sell a company that's trading at 100 times revenues. You balk. You say, no, it's cheap. You say, what do you mean it's cheap? Look at these 5 other companies. They're trading at 500 times revenues. Your cholesterol is 350. No, that's not a problem. No, it's okay. So what do you mean it's okay? Relative to people who've died of heart attacks in the last 2 years, you look good. If I pick the group I compare you to, I can sell you things, I can buy things from you because I frame the pricing. It's easy to frame pricing to sell whatever you're trying to sell.
We forget how much a valuation is playing defense. You know what I mean by that? You value a company, then you got to defend the valuation. And when you do a full-fledged valuation, your insides are out there for everybody to pick apart. Think about your DCF. I said, why is your revenue growth so high? Why are your margins going up to 35%? Why are you reinvesting so little? Your cost of capital looks low. I'm just picking apart your valuation because I can see every piece of your valuation. In contrast, let's assume you told me that you were pricing your company at 8 times EBITDA. Why? Because that's what other companies in the sector trade at. Think of the target. It's tiny, right? I don't like 8 times EBITDA. You know what the response you give me is? Take it up with the market. With pricing, that's what you're saying. I'm just the messenger. You might not like paying 40 times revenues, but everybody pays 40 times revenues for AI companies. I'm just delivering the message. It's much easier to defend a pricing. And here's the coup de grace, the reason I think people eventually end up pricing things rather than valuing. I'm a true believer in valuation, but I'll confess, for me, true belief means I'm going to be right maybe 57. That's a good year, 57% of the time, maybe 60% of the time. I think if you do good pricing, maybe you'll be right 52% of the time. 60 beats 52, right? But here's the catch. When you're wrong with intrinsic valuation, you're far more likely to be wrong alone. You see why? With intrinsic valuation, you're often buying things when everybody else is selling. You're selling things when everybody else is buying. And you know what happens to people who are wrong alone? They get fired. Here's a simple suggestion. If you're going to screw up, have lots of company. And with pricing, you'll always have lots of company. Why do you buy all those .com stocks in the late 90s? What? Everybody else was doing it. Doesn't mean you will lose less money, but it does mean you will not get fired. When I first started teaching this class, I used to try to talk people into valuing things over pricing. I no longer do because most of you are going to end up with pricing jobs. I want to make you better pricers, and I want to give you the tools to price things better. Because even if you're a true believer in valuation, I think you need to understand the pricing process. So if your job is pricing, of course, you need to understand the price. But even if you are a true, and here's what, to make money on your valuation, what has to happen? The price has to move to value. Understanding the pricing process might give you a much better sense of timing and picking the right companies to make your bets. So even though I'm a believer in valuation, I actually price every company I value just to get a sense of what's the market doing, understanding how investors are pricing companies in that sector. And I want to give you those tools to be able to do the same thing. So I'm going to take you through the process of pricing. But before we do that, let's first look at the metric that we end up using, this multiple. Okay? Let's start with an obvious statement. Every multiple has a numerator and a denominator, right? The numerator is always a market price number. That market price number can be the market value of equity, market cap. It can be market value of equity plus market value of debt, which is the overall value of the firm, or it can be market value of equity plus debt minus cash, which is called enterprise value. But they're all market numbers. So the numerator is always, what is the market paying for this company? In the denominator, here are your choices. You can divide that number by revenues. Why would you do that? Desperation. You know why you use revenues? Because you have money losing companies, the net income is negative, the EBITDA is negative. You keep climbing until you hit a positive number. And I don't think accountants have still figured out how to make revenues negative. Thank God for that small blessing. See, divide by revenue. So anytime you see a revenue multiple, what's the analyst saying?
I'm desperate. I'm going to go to revenues.
What if you have a company that's pre-revenue?
You know, a pre-revenue company is just an idea in somebody's mind. So what do you divide the market value by? Random, you don't want to use the word random, something that might give you revenues in the future. Now, do you see the rationale for using users? It's not irrational. You're saying, I don't have revenues, so I'm going to divide by the number of users, number of subscribers, number of downloads, number of people looking at my website. It sounds irrational, but the denominator needs to be a positive number. You're saying, what if I don't even have that? Divide by the number of cars in the parking lot for all I care. Ultimately, you need numbers to scale your market cap to, and that's going to be true for every multiple. You could divide by earnings. Those earnings can be to equity investors, which is net income, or to all investors, which is operating income. You can divide by cash flows, which for the equity can be adding depreciation to net income. It's kind of a rough measure of free cash of a cash flow to equity. But you might say, look, I remember my valuation class. I'm going to do free cash flow to equity, which requires what? CapEx, depreciation, working capital. You know why you almost never see that in pricing? Why do people do pricing? Because they're lazy. They don't want to make those estimates. They're not going to do CapEx and working capital. They want to stop at net income plus depreciation. Or if you're looking at the entire firm, you can do free cash flow to the firm. But again, that's a lot of work. So people take the shortcut, which is take operating income, add back depreciation, amortization, which is EBITDA. Or you can divide by what accountants tell you your company's worth. Where do they tell you that? On the balance sheet, they give you a book value of equity, which is and they give you a book value of debt. And if you add the book value of equity plus debt, you get the book value of the entire firm. And if you net cash out, you get invested capital, all book value numbers. So next time you run into a multiple, deconstruct what's in the numerator, what's in the denominator, because I'm going to give you a 4-step process for deconstructing multiples. I promise you, if you follow this process religiously, you will be a much better pricer. First step in the process is I'm going to start by defining the multiple. And some of you are going to feel insulted. You're saying, I know what a PE ratio is. I'm a junior at NYU. I know that when I was 6 years old. I've been trading stocks forever. I'm going to challenge you on that. When you talk about PE and I talk about PE, are we talking about the same thing? So I'm going to start with defining the multiple and putting it through a couple of tests to make sure it passes those tests. Second step, I'm going to describe the multiple. Sounds like I'm going to do something fancy, right? But I'm going to play Moneyball. You guys watch that movie? Make that your assignment for this weekend, okay? Moneyball is one of the best movies ever made, in my view, and the best books ever written. Does anybody want to tell me what the movie's about? It's Billy Beane, who was manager of the A's, okay? So he's a young manager, he gets hired at the, and in baseball for a century, the way you made decisions is you had these old scouts who would come around and give you this, based on my experience, this guy has a crooked elbow, and people with crooked elbows become great pitchers, so you should pay him $15 million. And people would invest huge amounts of money. And Billy Beane, after the fifth or sixth time, based on this rule of thumb, said, these guys have no idea what they're talking about. So at least in the movie, he hires Jonah Hill, who's this young MIT graduate who comes in and says, we have the data. What's the objective in baseball? You got to get around the bases and score. It's a very simple sport, if you think about it. We have data on how many people get to first base, how many of those people get to second base, and what kinds of people are more likely to get to first base. He said, let's let the data tell us who to sign. So they can pick up this minor leaguer who got a terrible batting stance. He doesn't look like anything scouts say a great hitter should look like. But it turns out that he walks an awful lot. He finds a way. You know, if you've never followed baseball, this whole thing is going to be completely mysterious to you. But in baseball, when you get to 4 balls and you don't have 3 strikes, and you get to first base, and they discovered he was getting to first base a lot more than all these star hitters who had the right. The guy called Kevin Youkilis. Guy I absolutely hate because I'm a Yankee fan and he ended up becoming a Red Sox player, and he got on base a lot more than I ever wanted him to. But that's data driving your decision. So essentially he said, hey, these scouts have no idea. The rules of thumb make no sense. We're going to let the data tell us. Do you have the equivalent in markets? We have scouts going around with rules of thumb. Awful lot of rules of thumb, right? 10 times earnings is cheap. How do you know? That feeling. Peg ratio less than 1 is cheap. Who makes up this crap? But you have decisions. I can understand the 1960s and you did this. I can understand why, right? You don't have data. You don't have data. Today, what's your excuse? So when I talk about describing the data, I'm going to take all of the data and I'm not going to tell you what the right or low PE ratios. Look at the distribution. You're smart enough to figure out what looks low, what looks high without me jumping in and say 8 times earnings is cheap. That's describing the data. Then I'm going to analyze the data, analyze the multiple. What does that mean? Remember, I promised that behind every multiple are the assumptions you're running away from, cash flows, growth, and risk. They're in there. I'm going to give you a mechanism for determining what those variables are, which will let you ask the right question the next time somebody tries to sell you something as cheap. And only then am I going to apply the multiple. Define, describe, analyze, apply. You know, the problem with pricing is people are sloppy. They're in a hurry. They want to apply things, but they've. So there are lots of people using EV to EBITDA, but if you ask them, what is the median EV to EBITDA for the market? They have absolutely no idea. And I don't trust somebody who's using a multiple has no sense of what the data looks like in the cross-section. So I'm going to start with the definitional test. I come to you with a multiple. Here's the first test you have to make it pass. Is it consistently defined? I'm saying, what does that even mean? Remember I said every multiple has a numerator and a denominator. If your numerator is an equity value, your denominator has to be an equity value as well. If your numerator is a firm or an enterprise value, your denominator is to be a firm or an enterprise value as well. No idea what I'm talking about, right? Late in the evening, you had a long day. So I'm going to hit you with a couple of actual multiples. You tell me whether they passed this test. Let's take PE ratios. What's in the numerator? Equity value, firm value, enterprise value. Equity value, market cap, price per share. What's in the denominator? Earnings per share. Equity value, firm value, enterprise value. Equity earnings, right? You take net income divided by, thank God for small blessings. The most widely used multiple in the world passes the test. What about EV to EBITDA? What's in the numerator? Market value of equity plus market value of debt minus cash. Market value of the operating assets of the company. What's in the denominator? A rough measure of operating cash flow before taxes and reinvestment. No, EBITDA. What about price to EBITDA? The analyst who invented this multiple should be tarred, feathered, and driven out of the fraternity if one exists. This is a horrifically bad multiple. And out of the 550 equity research reports I had, 10 use price to EBITDA. One of them happened to be somebody who had taken this class. I recognize them, he had an unusual last name. So I called him days before email and said, and notice you've been, you're an analyst in your price. Do you remember the valuation class you took a few years ago? He said, vaguely. I said, it shows. I said, what the heck are you doing? Dividing market cap by EBITDA? It's inconsistent. He said, no, I'm being consistent. I said, what do you mean you're being consistent? He said, I use price to EBITDA for all 15 companies in my sector. I said, that's a very strange definition of consistency. But let me ask you a question. Have you been noticing that companies with a lot of debt keep looking cheap to you? He said, yes, I've been noticing that. I said, have you ever stopped and asked why that might be? Do you see why, if you use price to EBITDA, companies with a lot of debt are going to look cheap to you? Let's take an example. Let's suppose you have a company with $1 billion, no all equity, no debt. The company does a stock buyback. It borrows $600 million and buys back stock. It removes the equity. So basically the equity will shrink from $1 billion to 420 or 450. So the equity is shrunk. What happens to EBITDA? It's before interest, taxes, and depreciation. The more levered you get, the cheaper you're going to look on a price to EBITDA basis. Before you feel too superior to this guy, every time you use price to sales, you're guilty of the same sin, right? Price is market cap. See, how do people get away with it? Sector where price to sales gets used the most is technology. So it's your redeeming grace. There's no debt.
You got away by accident. It wasn't because you were doing the right thing. So is it consistently defined? Is it uniformly estimated? What does that mean? If I'm comparing PE ratios across 15 companies, I want earnings per share to be computed the same way for all 15 companies. I used to think we were home free in the US because we had the same accounting standards, right? GAAP. And then I discovered, especially over the last 2 decades, that you could have the same accounting standards and different degrees of fidelity to those standards. In other words, you didn't have to break the rules, but there's enough leeway that if you're an aggressive company using the same accounting rules, you can report higher income than a conservative company. And if I'm not careful, I'm going to keep finding aggressive companies to look cheap because their earnings are high. S&P about 15 years ago started a service which they discontinued, but they took the earnings reported by companies with GAAP and actually restated those earnings, trying to correct for those things that created these levers. The demand was not there. Consistently defined, uniformly estimated. So I'm going to make you apply this with actual multiples. Let's start with the PE ratio. As I said, everybody knows what the PE ratio is. I remember about 30 years ago, I subscribed to Barron's. You know why I subscribed to Barron's? Because they offered to send me a calculator that would compute PE ratios. Free. I said, this is amazing. This is days before Wi-Fi and iPhones. So I get the calculator in the mail. It's this cheap little piece of crap. And it comes with instructions on how to compute the PE ratio. And here's what it says. Enter the price, hit the slash. They said the slash. Enter the earnings per share, hit equal. I got exactly what I deserved, right? Price divided by earnings per share. No wonder it was free. Even Anna Kournikova seemed to know what the PE ratio was. Remember Anna Kournikova? You guys are too young to remember her. She masqueraded as a tennis player for like a decade. She was a Russian tennis player. Masqueraded in what sense? She won nothing, but turned up in every commercial you could think of. She was like the Maria Sharapova without the talent. So this was like 2001 or 2002. This is a Charles Schwab commercial. I almost canceled my Schwab account right after I saw this commercial, where Anna Kournikova is playing somebody. Must have been an actress. She was actually winning. And you know, in tennis, every 2 games you switch sides because you don't want the sun in your eye. It's not fair. So the middle of a tennis match, they're switching sides. And for whatever reason, Anna turns to this actress and says, price earnings ratio is price divided by earnings per share. And then she kept going on something about preferred dividends that went completely over my head. And I remember turning off the commercial saying, does Anna Kournikova really know what the PE ratio is? It must be simple, right? Numerator is usually the current price. Unless you're one of those technical analysts gone crazy who likes moving averages for things. To which my response is, have you ever tried buying a stock at a moving average price? Go on to Schwab online, say, I would like to buy the stock, not at the current price, but the moving average price. It doesn't work. So it's kind of an irrelevant number, but they think smoothing things out makes things better. But the denominator is where you get the real differences, right? I can divide price by earnings per share in the most recent fiscal year, which is called current PE. I can divide price per share by earnings per share in the last 4 quarters, which is called trailing PE. I can divide price per share by expected earnings per share in the next 4 quarters, which is called forward PE. Or I can divide price per share by expected earnings per share in the year 2030, which is called really, really forward PE. Saying, why would I do that? Again, desperation. You're the biotech analyst. Every company in your sector is losing money. The only tool you have that you would know how to use is PE ratios. You know what you do? You project the earnings out for every company 10 years forward. So that company looks cheap. It's trading at 8 times 2030 earnings. And while you're scratching your head, say, what exactly do I do with that? They sell you the stock and move on. You can have earnings per share before extraordinary items, after extraordinary items, before stock-based compensation, after stock-based compensation. I remember about 10 years ago, I took Cisco, widely followed stock, and I computed 34 different PE ratios for the company at one point in time, different measures of earnings per share, ranging from 14 to 60. Let's say you're a bullish analyst on Cisco, and you're trying to sell me Cisco. Which of those numbers are you going to latch on to? The low end of the range or the high end of the range to convince me it's cheap? You're going to go with the 14. And if you want to convince me Cisco is expensive, you're going to go with 60. The next time you watch an analyst on CNBC, this is not, I'm not suggesting you watch CNBC, but if you're in the habit of watching CNBC, if you see a bullish analyst, notice they will always use forward earnings. You know why? Because expected earnings are higher, the number looks lower. Bearish analysts tend to go with trailing earnings. They never talk about the bias in this process, but that's how it plays out. So if I'd been making that Schwab commercial, you know what I'd have made the actress turn to Anna and ask, forward earnings or trailing earnings, Anna? Then we'd have discovered how much Anna Kournikova really knows what about PE ratios. But let me build on the theme. Let's talk about PE ratios. Let's say you're looking at companies, technology companies, and they use stock-based compensation. Let's say they use options to reward their managers. So some companies use very little, some companies use a lot, and you're trying to come up with a metric you can use to compare across companies. I'll give you 3 choices. And with each one, I'm going to argue there's going to be a bias you're going to end up with. And I want you to tell me what bias you're going to end up with. I could divide price or the market cap by the actual number of shares. I'm sorry, I could divide net income by the actual number of shares outstanding. Ignore options entirely. It's called primary earnings per share. What kinds of companies am I going to find? So I'm comparing across 50 companies. Some use no stock options, some use a ton of stock options. Which group of companies am I going to find cheap if I take price and divide by the actual number? I'm sorry, net income and divide by actual number of shares outstanding. The stocks that I'm going to find cheap are going to be the companies with a lot of options. And think of why. My market cap is going to get pushed down because the market knows I have hundreds of millions of options, but I'm ignoring it entirely when I do the earnings per share. If I go to fully diluted at the other extreme, I'm going to switch the bias, pushing the other way. Partially diluted, you're neither here nor there. You're still going to have biases. You're saying, what should I do? I'll tell you what you need to do, but nobody will ever do this. What's causing the problem here? I have options, and options are not 0-1 securities. They don't lose all value when they go below the exercise price. So what did we do in discounted cash flow valuation to deal with options, right? We value the options as options. You know what you need to do? You need to value all the options as options added to the market cap of the company. That's the total value of equity in the company, because the market cap is only the common shares. Add this, your total value of equity, you divide that by the net income, that'll factor in the fact that some companies have no options, some have a lot of options, some in the money options. You know why this will never happen? Because it's too much work. The reason people do pricing is they want to do things quickly. Maybe if Capital IQ valued the options for them and told them what they were worth, they would start using it. But right now, nobody does it. Let's take the third example. I want somebody who might have interned at an investment bank or an equity research department to volunteer themselves to be my guinea pig now. Anybody want to? Come on, I will make you look really good. I'll make you look brilliant. No, nobody wants to do this. The fastest growing multiple in use. You want to be? Okay, good. So EV to EBITDA were the fastest growing multiples in equity research. When I started in the mid-80s, maybe 1 in 100 equity research reports were based on EV to EBITDA. Now I'd say 35% of equity research is based on EV to EBITDA. And I'll go through what the definition is. Numerator is market value of equity plus market value of debt, though we cheat on that one. What do most investment banks use? They use book value, and they say, how different can it be? They can be different, but they wave their hands, and then they subtract out cash. So here's my question. Why do we subtract out cash? Or why do we use enterprise value? Why don't we use gross debt? Why do we use net debt when we compute this multiple?
Well, use net debt because one of the ways I've heard is that you can assume that your cash balance can be used to immediately pay off any debt obligations.
So should I be netting out all liquid assets then?
Well, it depends. For some valuations, I remember we used cash and marketable securities. For some valuations, we did just cash.
But what if I have some receivables that I can convert to cash by factoring them? Should I net those out too? I'm pushing you on the liquidity argument because I can take the liquidity argument and you can very quickly see that Now you could make this work. What if I told you it has nothing to do with liquidity? What do you think it is? You're getting closer. Look at the denominator and you'll see why. So I'm going to come back to you. What's in my denominator? EBITDA, right?
Yeah.
Where does the interest income from cash show up in an income statement?
Does it show up?
Above or below the line? Above or below EBITDA?
I think it's
Below.
it.
Yeah. In other words, my EBITDA doesn't include the interest income from cash. I'm taking cash out because the income from cash is not part of my denominator. I've now opened a Pandora's box because in addition to netting cash out of the numerator, you know what I should also be netting out? What's the other big asset category whose income doesn't show up as part of my operating income? We dealt with this in DCF with emerging market companies of a lot of these. Cross holdings in other companies, right? You own 5%, 10%, 15% of another company. That income is not part of EBITDA. So if I'm computing EV to EBITDA for a company with cross holdings, in addition to netting cash and marketable securities out, I should be netting out the value of cross holdings, because if I don't do that, companies with cross holdings will keep looking expensive to me because I'm counting in the numerator something that is not in the denominator. And God help you if you have a majority holding, right? Because think about the mismatch you've created. The market knows you own only 60%. So that's 60% in there. But everything else comes from a consolidated statement. Your cash, your debt, your EBITDA are all 100% of the subsidiary. Do you know how analysts adjust for it? If you wanted a quick fix to the numerator to bring in the portion you don't own, what's the number in the balance sheet that supposedly captures that 40% that doesn't belong to you? Minority interest. You will see people adding minority interest in the numerator. The reason they're doing it is to try in some half-assed way, at least, to get consistency. Why half-assed? Because minority interest is a book value and everything else is a market value. You thought you were going to run away from cross holdings, and that's why you didn't want to do discounted cash flow valuations, and that's why you started using multiples. Guess what? They're going to chase you down. And they're going to affect whatever multiple you use. So there is no getting around the issues that made discounted cash flow valuation difficult. They're just going to show up in a different form when you use multiples. And one final question. Let's suppose you want to compare stocks to real estate. You're trying to decide where should I put my money. Stocks, of course, you have PE ratios, you have EV to EBITDA multiples, the S&P 500. You see, is there a metric I can compute in real estate which will tell me whether I'm paying too much for real estate? There's actually a metric that some housing valuers, appraisers, or macro housing people use. And here's what they do. They take the price of a house, a median price or an average price or whatever price of a house is, and they divide it by the rental income you would get today if you rented that house out. You see what they're trying to compute, right? If you're paying $1 million for a house, and you can rent that house out for $50,000 a year, $1 million divided by 50,000 gives you a housing price to rental income ratio. So here's my question. If that's the ratio you're computing, and you're trying to compare it to an analogous ratio in the equity market, what would you compare it to? Let me try some things. Would you compare it to the PE ratio? Why or why not? Housing price divided by rental income. What does PE ratio look at? The equity investment in a business, right? When I divide housing price, I'm looking at the entire price of the house. I'm not looking at how much equity invested in the house. I'm looking at the total price of the house. So it's more like enterprise value than equity value because you're looking at the whole price of the house. Now the question is, what is rental income like? Is it like revenues? Is it like EBITDA? Is it like... No. It's a tough call, right? Because you collect rental income. Remember, interest expenses, you can't count in anymore because you're looking at enterprise value. What are your expenses? It could be property taxes, because you got to pay those. It could be maintenance expenses. If you subtract those out, you get something like an EBITDA that you can use. But if you don't, this is closer to revenues than it is to EBITDA. No, it's a work in progress because nobody really does this on a consistent basis. But I think it might actually be worth getting a track record of this over time to see if it does predict. Real estate historically goes through this boom and bust, whether you can get that by looking at this ratio relative to what the bond market is at and what the stock market is at. So let's at least get started on the descriptive test. Okay?
the statistics class, I give you data. What are the standard variables you compute on the data? It's almost automatic. Average standard deviation. Start with that, but don't stop there. To me, the most useful part of this descriptive data is the visual part, seeing the histograms, because by itself, everything else is abstract, right? Mean. So you can take Excel and compute every conceivable, skewness, kurtosis, all that neat stuff, but it's kind of meaningless until you look at the distribution. So as you look at the distribution, here are some of the things I want you to think about. Is it symmetric or asymmetric? That goes back to, can I use averages? I also want to look at when I start with data, am I losing some of the data in computing this histogram? Sounds mysterious, but let me show you a histogram I do at the start of every year. I've done it for 30 years, where I take every publicly traded stock in the US and I compute 3 different PE ratios: current PE, trailing PE, forward PE. Remember, I do this at the start of each year. Start of 2023, current PE would usually be 2021 data, right? Because the most recent fiscal year hadn't shown up yet. Trailing PE would be through September of 2022, and forward PE would probably be from September 2022 to at least I'm being consistent on each of those. And then I draw the histogram. So it's not rocket science. I take the data. Remember what I said about asymmetric distributions? You see that in the distribution, peak to the left, tail to the right. In fact, I've artificially cut off the tail to the right by counting any PE ratio above 100 as a grouping. But if you went, broke that down, the tail would keep stretching up. So that's the asymmetry in the distribution. But here's how it shows up in the numbers. I computed the average PE ratio for the company, for US companies. The start of 2023, you know what that number looked like? 109.25 times earnings. If I told you that the average US company is trading at 109 times earnings, you should freak out. But it's a lie. The median PE at the start of 2023 was about 14 times earnings. And there's the reason. There's a PE ratio of 86,400. There's a very low PE ratio, but there's no negative PE ratio to offset it. But there's one more number I want you to look at. So look at the top. It says number of companies, 7,165. But only 3,099 seem to have made it into my PE ratio sample. So why did I lose the other 4,000 plus companies? What happened? They had negative earnings. And you think that must be terrible. I've done this for 30 years. Every year I lose at least 60% of my sample to negative earnings. In years like 2009, I lose 70%. You might say, so what? I still have a lot of companies left over. You do, but do you create bias when you lose those 4,000? What kinds of companies tend to have negative earnings? Small companies, risky companies, young growth companies. This is not randomly picking out 4,000. I create bias in my averages and aggregates when I remove these companies. And I've struggled with that because if you go to my website, I report average PE or PE by sector. And when I first started doing this, the way I did it was I took the companies which had PE ratios and averaged across them. So let's take a sector with 350 companies, but only 20 have positive earnings. I should take those 20 companies, average the 20 and say, this is the PE ratio. That's not right, because 330 companies I'm throwing out, there's bias. So here's what I do now, but it's a work in progress. If you can come up with a better way of doing it, I'm willing to listen. I add up the market cap for all 350 companies, including the money-losing companies. I add up the net income for all 350 companies, including the money-losing companies. And then I divide the aggregated market cap by the aggregated net income. You see what I'm trying to do, right? I'm trying to keep the companies from getting thrown out because I want to get a sense of the sector, and this gives me a clearer measure of that sector. So first reason to look at the data is to understand the statistics. One more thing, as I go from current PE and trailing PE to forward PE, I lose another 600 companies. Why is that? What do I need for forward PE? I need expected earnings next year. There is zero chance that I'm estimating expected earnings for each of 7,165 companies. So you know what I rely on, right? Capital IQ actually gives you expected earnings per share next year that analysts have projected for this company. So you know what 600 companies are loose? Companies that are not followed by analysts. What kinds of companies will those be? Small companies, off the exchange companies. We create bias in without even realizing. the choices we make about what multiple to use can actually create biases in our sample. Until about 2003 or 4, I used to do just US companies, not because I'm parochial, but because that's what my raw data was. I used to actually subscribe to the service called Value Line. They'd give me a CD every year of all the US companies they tracked. In 2004, I decided to switch gears. And here's why. I would take this graph that I showed you for US companies. I'd go to Sao Paulo or Mumbai or, and I'd show the graph, and some grizzly 50, 60, 70-year-old analyst would put up his hand and say, it doesn't look like anything like that in Mumbai. I say, anything like what? Well, the peak to the left and tail to the right. It doesn't look like that for Indian stocks. And I said, how do you know? The gut feeling. I said, I don't trust your gut. So I said, I'm going to test out whether your gut feeling is right. So I expanded my sample to global companies. And this is something I do every year now. I graph out US companies, emerging market companies, global companies. When you look at those charts, what's the first thing that jumps out? They all peak to the left, tail to the right. Doesn't mean that P ratios don't vary across markets. And already we're going to start thinking about why P ratios vary across. What's the cheapest part of the world to invest in at the start of 2023? If you just went low P. Eastern Europe and Russia, why don't we put our money there? That's a good idea. But you should have second thoughts about what's the question I forgot to ask before. How risky are these companies, right? Canada is a puzzle. We'll come back to it when we start. I want you to think about what it is that causes PE ratios to vary across markets, because that's going to be the building block for what we start with next session. I would see you on Monday.
And incidentally, if you haven't sent in your DCFs yet, I am leaving the window slightly ajar, and if you send it, I will get it back to you, okay?